The S&P 500 has dropped 9% from its recent highs. For many, this looks like a standard correction, but for anyone who entered at the peak, it represents a significant erosion of capital that often triggers a desperate urge to buy the dip. This initial 9% decline appears to be the opening move of a broader correction. Based on current momentum, we should expect the index to extend its losses into the double digits before we see any meaningful attempt at a price floor. That floor is frequently a setup for a fakeout, a sharp, aggressive bounce that convinces retail traders the worst is over, right as the market prepares for its next leg down. The difficulty in spying this trap lies in our reliance on the US dollar as a yardstick. When the value of the currency itself is shifting, the price of the S&P can look like it's recovering, even when the underlying value of the assets is still rotting. To navigate the next few months, we have to look past the dollar-denominated charts. By changing our perspective, we can see the specific mechanics that are currently being used to mask the market's true direction. We can get a clearer view of the current path by comparing the S&P 500 to Bitcoin. When we align their most recent peaks, we see that equities are essentially following a blueprint that the crypto market has already completed. Bitcoin's breakdown followed a clear three-step sequence. It dropped from its high, bounced back up to test its bull market support band as resistance, and then plummeted to a new local low. The S&P 500 is currently mirroring this behavior, but with a several-week lag. It has finished the initial 9% drop and is now lingering in that pre-bounce phase, just as Bitcoin did before its fake-out rally. This projection points toward a local bottom in April. This is based on the market's tendency to repeat lows in yearly cycles. During the dot-com era, we saw major lows hit in October of 1998 and then exactly 1 year later in October of 99. Since this current cycle saw a significant low in April of 2025, structural symmetry suggests April of 2026 is the next window for a bottom. If that April window holds, it marks the moment the counter-trend rally begins. This is where the trap is set, a period of rising prices that feels like a new bull market, but is actually a hunt for liquidity. To see the true strength of this market, we have to price the S&P 500 against gold. This removes the noise of dollar inflation and shows us the real purchasing power of the index. On this chart, the current structure is a match for the fractals of 1973 and 2008. In both cases, the S&P suffered a major structural breakdown against gold that signaled a massive shift in the macro trend. Historically, these breakdowns are heavy indicators. In both 1973 and 2008, once the S&P fell below these specific gold relative levels, the market never returned to an all-time high for the remainder of that business cycle. However, we get a different signal when we price the S&P 500 against the M2 money supply, essentially measuring the market against the total amount of cash in the system. The M2 chart currently matches the 1996 to 1999 dot-com era fractal. This tells a slightly different story than the gold chart, showing how excess liquidity can skew price action. In 1999, the market saw a 15% drop, followed by a sharp rally that actually pushed past the previous all-time highs. It was a final sweep of the peak that lured in buyers just before the bubble finally burst. The divergence between these two charts, a breakdown against gold and a potential final sweep against M2, suggests that any upcoming rally is likely a structural trap. It points to a market attempting to find one last wave of liquidity before the broader multi-year drawdown begins in earnest. When the April rally arrives, look closely at which stocks are moving. It's likely that the index will be propped up by sector rotations rather than the tech leaders that drove the previous year's growth. Money tends to flow into defensive sectors during these periods. This creates an illusion of health for the overall index, even as the most speculative and high-growth parts of the market continue to struggle. While a lower high is the most probable outcome, stay alert for a brief sweep of the all-time highs. As we saw in 1999 and 2007, the market often makes one final, aggressive move upward to catch short sellers off guard before the real decline begins. High volatility environments like this require precise execution. Using reliable platforms with deep liquidity is the only way to ensure you can exit or adjust your positions without being trapped by slippage or system lag during a sudden drop. The goal is to avoid becoming exit liquidity. By positioning defensively now, you can watch the counter-trend rally from the sidelines and wait for the true macro bottom to form. Anticipate the April window, Understand the hollow nature of the bounce, and don't let a temporary rally distract you from the long-term data. Protecting your capital today is what allows you to buy the real bottom tomorrow.